The financial world watched in disbelief today as the United States, under the direction of President Trump, detonated a tariff bomb on Chinese imports. This unexpected move has sent ripples through the global financial markets, causing immediate reactions from investors, traders, and governments alike. The implications of such a drastic measure are far-reaching, affecting not just the two countries involved, but the entire global economy. These weren't your run-of-the-mill tariffs either. They represent a significant departure from previous trade policies, marking a new era of economic confrontation between the world's two largest economies. We're talking a staggering 145% increase, a move that has sent shockwaves through global markets and left economists scrambling for historical comparisons. The sheer scale of this tariff hike is unprecedented, and its immediate impact has been felt across various sectors, from technology to agriculture. The White House, far from shying away from the move, offered a full-throated defense of the tariffs, arguing they were essential to protect American jobs and counter what it called unfair trade practices by China. Administration officials have been vocal about the need to address the trade imbalance and have framed these tariffs as a necessary step to level the playing field. The administration claims that China has been engaging in intellectual property theft and forced technology transfers for years. They argue that these practices have given Chinese companies an unfair advantage in the global market, and that the tariffs are a way to push back against these long-standing issues. They argue that these tariffs are a necessary tool to bring China to the negotiating table and force them to change their ways. The hope is that by applying economic pressure, China will be compelled to adopt fairer trade practices and respect international norms. Critics, however, argue that these tariffs will do more harm than good. They warn that the increased costs of imported goods will be passed on to consumers, leading to higher prices and reduced purchasing power. Small businesses, in particular, may struggle to absorb these costs, potentially leading to closures and job losses. This aggressive action represents a significant escalation in the ongoing trade war between the world's two largest economies. The stakes are incredibly high, and the potential for retaliation from China could lead to a tit-for-tat cycle of increasing tariffs, further destabilizing the global economy. It comes after a period of relative calm, with many hoping that a deal was within reach. The sudden imposition of these tariffs has dashed those hopes, reigniting tensions and uncertainty in international trade relations. Instead, we are now facing the prospect of a full-blown trade war, with potentially devastating consequences for the global economy. The interconnected nature of modern economies means that disruptions in trade between the US and China will have ripple effects, impacting countries and industries around the world. The timing of the announcement, coming just weeks after the US and China appeared to be making progress in trade talks, has only added to the sense of confusion and uncertainty. Many are questioning the strategic rationale behind this move and whether it will ultimately achieve the desired outcomes. Many analysts believe that this latest move by the Trump administration could derail negotiations and lead to a protracted and damaging trade war. The long-term effects of such a conflict are difficult to predict, but the immediate reaction from markets and experts suggests a turbulent road ahead. So what exactly do these tariffs cover? Buckle up, because the list is extensive. The 145% increase applies to a broad range of Chinese goods, from electronics and machinery to clothing and footwear. This includes a new 125% tariff on top of a pre-existing 20% tariff related to fentanyl, a synthetic opioid that has ravaged communities across the United States. To make matters worse, the administration left existing tariffs on automobiles, steel, and aluminum in place. This means that American consumers and businesses will be paying significantly more for a wide range of products, potentially leading to higher prices and reduced consumer spending. The tariffs are expected to hit certain sectors of the U.S. economy particularly hard, including agriculture, technology, and manufacturing. For example, American soybean farmers, who have already been struggling due to the ongoing trade war, are likely to see their exports to China plummet even further. The technology sector is also bracing for impact, as many American companies rely on Chinese suppliers for components and finished products. The tariffs are expected to disrupt supply chains, leading to higher costs and potential delays in product releases. The reaction on Wall Street to the tariff announcement was swift and immediate. Traders, investors, and financial analysts were all caught off guard by the sudden news, leading to a frenzy of activity both inside and outside the stock exchange. The response was brutal. The Dow Jones Industrial Average, a key barometer of American corporate health, plunged by 2.54%, wiping out billions in shareholder value in a matter of hours. This dramatic drop sent shockwaves through the financial community as investors scrambled to reassess their positions. The tech-heavy Nasdaq Composite Index fared even worse, plummeting over 4% as investors fled from companies heavily reliant on Chinese manufacturing. Tech giants, which have been the darlings of Wall Street for years, suddenly found themselves at the epicenter of the market turmoil. Even the broader S&P 500, which tracks the performance of 500 large-cap U.S. companies, wasn't spared. It shed 3.5% of its value, erasing weeks of prior gains. This index, often seen as a more comprehensive measure of the market, highlighted the widespread nature of the sell-off. The bloodbath on Wall Street reflects the deep anxiety among investors about the potential fallout from a full-blown trade war. The fear is palpable, as market participants worry about the long-term implications of such economic policies. They fear that these tariffs will damage already fragile global growth, disrupt supply chains, and lead to higher prices for consumers. The interconnected nature of the global economy means that the ripple effects of these tariffs could be felt far and wide, affecting industries and consumers alike. The sharp sell-off in the stock market is a clear indication that investors believe these tariffs are bad for business, bad for the economy, and bad for the United States. The sentiment on the street is overwhelmingly negative, with many fearing that this could be the start of a prolonged economic downturn. Adding to the sense of panic, the yield on 10-year U.S. Treasury bonds, seen as a safe haven during times of economic uncertainty, climbed to 4.4%, a level not seen since February. This rise in bond yields is a clear signal of growing investor fear and a flight to safety. Even the price of oil, a globally traded commodity, wasn't immune to the turmoil. It tumbled below $64 a barrel as traders factored in the potential impact of the tariffs on global demand. The energy sector, which is often seen as a bellwether for economic activity, is now facing significant headwinds. The repercussions of the tariff announcement were not confined to the United States alone. Global stock markets also reacted sharply, with major indices in Europe and Asia experiencing significant declines. The interconnected nature of today's financial markets means that a shock in one region can quickly spread to others, amplifying the overall impact. Economists and financial analysts are now debating the potential long-term effects of these tariffs. While some believe that this could be a short-term blip, others warn of more severe consequences if the trade tensions escalate further. The uncertainty is causing a great deal of speculation and concern among market participants. On Main Street, the impact is also being felt. Small businesses, which often operate on thin margins, are particularly vulnerable to the increased costs that tariffs can bring. Consumers, too, are starting to see higher prices for everyday goods, adding to the overall sense of unease and uncertainty. The initial euphoria in global markets, particularly in Asia and Europe, following President Trump's earlier announcement of a pause on most new tariffs, proved to be tragically short-lived. The optimism that had briefly lifted the spirits of investors and traders was quickly replaced by a sense of impending doom. European indexes, which had experienced their most significant one-day gains since 2022 on the news of a potential trade truce, are now bracing for a sharp reversal. The initial gains have been wiped out, and the markets are now in a state of flux, with volatility becoming the new norm. The imposition of these draconian tariffs has shattered any illusion of a trade peace. The global supply chains, which had been delicately balanced, are now facing unprecedented disruptions and injected a fresh wave of uncertainty into the global economy. Businesses worldwide, already grappling with slowing growth and geopolitical risks, are now left to navigate an even more treacherous landscape. The uncertainty is palpable, and the stakes have never been higher, are now left to contend with the prospect of a trade war between the world's two economic superpowers. The World Trade Organization, already weakened by years of attacks from the Trump administration, is now facing its biggest challenge yet. The organization's ability to mediate and resolve trade disputes is being put to the ultimate test, is now facing its biggest challenge yet. The WTO's credibility and effectiveness are on the line, and the world is watching closely. The WTO's dispute settlement system, often referred to as the crown jewel of the multilateral trading system, is likely to be inundated with complaints from both sides. The sheer volume of disputes could overwhelm the system, leading to delays and further complications. Is likely to be inundated with complaints from both sides. The potential for these tariffs to trigger a global recession is very real. As tariffs bite, the potential for these tariffs to trigger a global recession is very real. As tariffs bite, businesses will be forced to raise prices, leading to reduced consumer spending and slower economic growth. The ripple effects could be felt across all sectors of the economy. Businesses will be forced to raise prices, leading to reduced consumer spending and slower economic growth. The impact on everyday consumers will be significant, with higher prices for goods and services becoming the new reality, leading to reduced consumer spending and slower economic growth. If other countries retaliate with tariffs of their own, as seems likely, we could see a downward spiral in global trade, investment, and economic activity. The interconnected nature of the global economy means that no country will be immune from the fallout. We could see a downward spiral in global trade, investment, and economic activity. The long-term consequences of this trade war could reshape the global economic landscape for years to come. China, as expected, did not sit idly by while the United States erected massive tariff walls. Beijing responded with its own set of retaliatory tariffs, targeting a range of American imports with an 84% levy. This tit-for-tat escalation of tariffs is a dangerous game of economic chicken, with both sides seemingly determined to inflict maximum pain on the other. But China's retaliation went beyond just reciprocal tariffs. In a move that sent shockwaves through Hollywood, Beijing also announced a reduction in the number of American films allowed to be screened in Chinese cinemas. This targeted strike against a high-profile American industry is a clear signal that China is willing to use its economic and cultural clout to pressure the United States. The Chinese government has a range of other tools at its disposal, including manipulating its currency, restricting access to its vast market, and encouraging boycotts of American goods. The trade war is no longer just about soybeans and steel. It's about who will set the rules of the global economy in the 21st century. The stakes are incredibly high, and the potential consequences for both countries and indeed the world are enormous.